Good morning, ladies and gentlemen, and welcome to the show on this Wednesday, the 1st of December, 2021. Thank you for tuning in. Glad to have you guys here. Now, I'm going to tell you what, this whole thing, the whole economy is actually very weak. It's a very weak economy. We've been ravaged through years of pandemic that is, it's not the economy we had before the pandemic started back into. Well, that's obvious to you guys. Let's get started. I want to talk about this a little bit more. Let's open up the charts right here. Take a look. The Turkish Lira today, it's falling to new lows as the United States Federal Reserve hints at faster tapering schedule. The Lira fell as much as 4.7% to 13.45 liras to the dollar at 8:08 p.m. in Istanbul. You know, Turkey is a very large, powerful country, and don't take it lightly that their currency is losing value. It's heading toward hyperinflation. The Turkish lira tumbled to a record low, weighted down by the prospect of a faster pace of tightening by the U.S. Federal Reserve. Faster than the middle of next year, which is only like 6 months away. They want to taper down to zero. Even faster than that, they want to go. The economy can't take it. Of course, that's not going to be found out until after they do it. But the thing is what can stop them from doing it at this point? Well, there's that new variant that could put a damper on the tapering process, because the tapering is data dependent. And of course, the data comes in too bad, of course they're gonna stop with the tapering. They're right on to do it. Don't take, like a lot of people out there say, oh, they're never gonna taper, they're never gonna taper. You watch them. They're right on to do it. And the thing is they're well, I'm gonna tell you guys what. When the markets tumble out of bed, I'm gonna say that they're gonna be down about 20%. That they're gonna yield to the markets. Why I mean yield is, they'll stop the taper, and they might even go back to some form of stimulus or another after the markets fall 20%. But it's going to take that fall first that's going to shock them into turning on their heels in the opposite direction. It'll take that shock first. Okay, so it says here, Chair Jerome Powell said it's appropriate to consider finishing the central bank's tapering of asset purchases in a few months earlier than previously expected. That's compounding concerns over President Erdogan's drive for lower borrowing costs. So Turkey is having problems right now with the lira. Let's move on and take a look at silver today. It's really down right now at 22.68. It's down 16 cents. But it's been trading in this very narrow range right here, around $22. And looks like 22.85 is where it's been trading, in that little narrow band right there. It's dropped below that band right now to 22.68, but it looks like it's bouncing back up into that band again. That's a tremendously low price for what you're getting in silver, for a whole ounce of silver. What it takes to get an ounce of silver out of the ground and actually into a coin form. A lot of people don't realize how much work is involved. Let's take a look now at cryptocurrencies today, and what we're looking at is 2,682,000,000,000. I'm going to refresh the page to see which direction it's moving. So it's 2682, 2687. So it's moving up very slowly. We're looking at $58,401 for a Bitcoin today. Let's take a look at the Dow Jones today, which is up 271 points at 34,755. I'm going to tell you guys what. The Dow Jones is more, and all the other markets together are more pumped up right now than they ever have they've reached a peak even bigger than the dot-com bubble, bigger than the 1929 bubble. And they're poised where they could fall because underlying supporting economy, PE ratios, it's all gone it's all gone bonkers. I was sitting there searching in my mind trying to find a term to describe it, but it's all actually gone bonkers. They've pumped it up with buybacks, and honest to goodness, it's just the market is so pumped and so over leveraged. And same thing with the real estate market. It's the same deal with this same deal is in these inflated bubbles. And you got to understand at the core how money is actually created. Money is not actually money. It's all created from debt. There's debt associated with every dollar. If that debt was ever paid off, there wouldn't be any what we call money. It wouldn't exist. And money now has become just a floating ledger. It doesn't actually exist in the real world. There's very little cash. Cash is an ancient barbaric relic of what money used to be. It used to be something you could actually see and hold in your hand. Now it's just a ledger of credit that's floating around on the internet. From one, like say you got $1,000 in your bank account, so those are all just digits. It's 1,000 little digits. Okay, say you want to pull $100 out of there to pay for something at a store. They just change the ledger reading to now 900 in your account, and that 100 that you just took out goes to the store that you just paid for. It goes on their ledger. So they're just making ledger entries is all it is. But all those ledger entries in the system all have a debt attached to them. And that's the national debt. You see the national debt's like is moving up higher and higher every year, bigger and bigger. That debt is the money itself, but the debt is actually much bigger than the money itself, the actual money that's in existence. Like the money that you can actually hold in your hand, or even the units that you have in your bank or whatever. Those aren't as big as the debt, and the reason for that is it's structured the way it was originally set up back in 1913 with the Federal Reserve Act. It's the way it's structured. What they do is they basically loan money out. That's how money springs into existence. It's an exchange thing where they exchange the bonds for they create new bonds, and it's a racket basically. Basically it's a racket, but every dollar that they create in that racket has a debt associated with it per year, so it's accumulative. That debt is the money that's owed in interest. So they create the dollar. The Federal Reserve creates the dollar. We'll take it down to a $1 unit for an example. They create the dollar, and each year there's like a certain amount that's owed on that dollar in debt. It's, in other words, interest to be paid back on that dollar. They created the dollar, but they never created the interest to pay back on that loan. So if you pay the dollar back, well, now the dollar's been extinguished. The loan's been extinguished, but the dollar's been extinguished. But also it owes more in interest, the cumulative interest over as, see, you take 1913 all the way up to the present, and you take and accrue that interest. It just makes an enormous pile of interest. It's owed, but money that they never created to pay that interest. So if the whole thing starts, because all the money springs from debt, if you start to pay off the whole thing, then all the money disappears. Now what happens if the system crashes is that's basically them starting to pay off the debt. In other words, it's deflating, it's purging the system. They can't purge the system because all the money would disappear, what we call money, because it's all created from credit. This is a credit-based, debt-based system that we're running in right now. I know I'm getting sidetracked a little bit, but when you see a stock market crash, those are units vanishing of the money. Billions of dollars can vanish in a matter of minutes when you see all the markets starting to crash. That's money vanishing from the system. That's deflation. And they can't let that go too far because it's a cycle that is actually self-perpetuating within the system. Just like inflation is a cycle that's self-perpetuating. And these are like two sides of a coin. Heads or tails, but they're the same coin. So what you have is you have deflation and inflation coexisting, and what the Fed's trying to do and what the central banks try to do is find a balance between the two. But the more leverage that gets in the system, the harder it is to balance that between deflation and inflation. There's more pressure for it to go in one or the two directions. And the system, being as it's over leveraged right now, and they've lost the control mechanisms to control inflation, which is raising interest rates. They can't do that anymore. Shouldn't say they can't do it anymore, but it would crash the system. Well, we're at a point of inflection now at this point where it's very difficult to keep a crisis from popping up in the system overnight because of all the pressure that's there for a crisis to happen within the financial system. So it wouldn't take much of a trigger to start everything cascading downwards. But the other side of that is things going up, continually going up higher. And for that to happen, they have to have loose monetary policy. Right now they're moving toward tight monetary policy. So what could bring about loose monetary policy? A crisis. COVID crisis, some new crisis with that, a monetary crisis, a banking crisis. Crises bring more stimulus. So the front side of a crisis makes things fall. But then when the stimulus comes, then things are buoyed back up again. It was this COVID crisis that buoyed these markets up. This market right here was 20,000 before COVID. Now it's 34,710. It's done the same thing with Bitcoin. This is modern monetary theory, which is that you can print to infinity forever, and it just basically it's going to be the destruction of these fiat currencies ultimately in the end. Anyway, I'm getting off on a little bit on a tear here, but we're at a very precarious moment right now where if they try to cut back the monetary fuel that's brought these markets up to where they are, well, they're going to fall. It's just basically simple math. If you got a table, and it's got three legs underneath it, and you decide you're going to pull one of those legs, the three-legged table, you're going to take one of the legs away, the table's going to fall over. And that's just simple. You know that's going to happen. Well, that's the way with our economy right now. We're running on three legs, and Jerome Powell's decided he's going to pull one of the legs out from underneath the table by tightening. Now, what could stop them and make them move in the exact opposite direction? Well, a crisis similar to what happened back when they poured out all this stimulus back at the beginning of the COVID crisis. So, but if that doesn't happen, then they're planning on tightening, and they're going to see the markets roll over. And when they see the markets roll over, then that'll create a crisis, which will enable them to stimulate more on the other side. So we're going in this topsy-turvy, upside-down world where bad is good and good is bad. And the markets, for the markets I'm talking about, bad is good and good is bad. Let's take a look now at the oil price. It's $68.46. It's up $2.28 today, so it's back up trying to head towards $70. Move index today is 84.04, so we've seen a little drop-off today in the move index. It was up to almost 90. 84.04, still too high. Bonds and rates today, we're seeing the yields bounce back a little bit today. 3.7 basis points movement on the U.S. 30-year to 1.82. And the U.S. 10 years at 1.47, and it's up 3.6 basis points. Now for the dollar index today. 95.78, and it's starting to fall this afternoon. It's fell 22 cents this afternoon so far. Thank you guys for listening to my show. Like and subscribe. I know I told you guys about channel changes that are coming. There's been some things that have come up, but the channel changes that I'm going to make, or improvements I'm going to make to the channel, are still coming. It's just that I'm going to have to delay them out until the future just a little bit due to things that have come up. But I'm going to keep producing my shows for you guys, you know. It's just that the changes that I was expecting to make, they've been delayed a little bit longer, you know. So you guys are going to have to wait for that. Also for the pets, you know, I like to do pets every once in a while. You're going to have to wait for that a little bit too. There's a lot going on here around Christmas time, you know, and that's what we're coming up to. I'm hoping everybody out there is going to have a Merry Christmas. And you guys, thank you for watching my show. And we'll catch you guys in the very next episode. Bye-bye.